convertible notes are great, but they're also a bit of a mess. While investors in the US are very much accustomed to these fundraising vehicles, investors outside the US are not, and I really don't blame them because they are a bit of a mess. Safes try, they take the premise of a convertible note and they try to simplify the terms to make them easier to grasp for founders and for investors and even for future investors. People often forget about these guys. If your cap table is a mess today with preferred shares and weird exceptions, those are terms that your future investors are gonna have to understand as well. And that means due diligence that gets more expensive and potential deal breakers. But to understand both convertible notes and safes, you need to understand how startup equity works in general. And for that, we need to crunch some numbers. So we are very much used to hearing about percentage ownership on a company, but that's not really how startup equity works. When you establish a C corporation is the most common type of legal structure and definitely the one that investors want you to be using. But when you establish a C corporation, the company defines a finite number of shares. So let's use an example of a paper company that has two founders, Robert Dunder and Robert Mifflin. So when Robert and Robert established the company, they agree that they're gonna be equal partners, as most co-founders should. I made a whole video about how to split equity in the early stages of the company, so you should check that out if you don't trust me. 50-50 is ideal. Anyway, this means that each of them is gonna get 50% of the company equity, but that 50% is gonna be represented in a number of shares. So a common approach here would be to establish the business with 10 million shares, and then 5 million shares of stock for each one of these two founders, 50%. Those 5 million shares of stock each founder owns are never changing. They usually can't be sold or passed along to anyone unless the rest of the company approves it. It's a big board meeting mess. So for all certain purposes, you have to assume that each one of them will always own 5 million shares of stock for the company. So when a new investor comes in, the founders don't give any of their shares to the investor. Instead, the company will issue new shares of stock for that investor. How many shares get issued for that new person determines what the company valuation is. So let's look at an example. Let's say that Dunder and Mifflin agree to raise an initial round of $1 million. Investors decide that they would like 20% of the company in exchange for that money. But where does that come from? Why 20%? Why not 18%? Why not 15%? Well, by saying that $1 million equates to 20% of the company, we are also saying that the entire company is worth $5 million. The truth is that in the early stages of a tech startup, these percentages and these valuations depend mainly on the founder's bargaining power, on how exciting the space is, on how experienced the team is, and on how bullish the investors are about this company and this space. I've seen founders waste hours trying to justify these valuations on a spreadsheet when they have no revenue. And the reality is that unless you have some significant revenue in the millions of dollars, estimating a valuation for an early stage company is just fugazi. I'm gonna get back to this valuation, but I'm gonna show you how the transaction works in this case. So if founders and investors agree on that 20%, that means the post-money valuation of the company was $5 million. So the pre-money valuation in that case would be $4 million. You just take the post-money minus the investment, right? So the investors are effectively accepting that the company is worth $4 million before they inject the capital. Now they inject the capital, the company's worth $5 million. Now, what happens with share distribution is that the company is going to issue new shares for the new investor to buy. Again, founders are not going to be transferring any of their shares. So the company in this case is going to issue 2.5 million shares of stock for Dwight. This means that the new total number of shares for the company is 12.5 million shares, of which 5 million shares is 40% and 2.5 million shares is 20%. The effective price per share for the investors was 40 cents. Now, it's critical that you understand this pre-money versus post-money valuation difference in your term sheets and that you lay it out correctly, because if you're not careful, you could get screwed over a little bit. We made a whole video about going into details into pre-money and post-money, so check that out if you need to. So now that we're clear about how issuing equity works in this company, we can actually talk about these convertible notes and these safes. Now, the purpose of both of these fundraising vehicles is that they delay this conversation about how much the company's worth. As I said, valuations at the early stage are very speculative or completely speculative, and some deals just get caught up in that negotiation. So convertible notes and safes try to solve this. Let's cover convertible notes first. Since they effectively were invented first, as far as back as the 1800s, Wikipedia told me today. Anyway, what investors figured that they could do to invest in a company without knowing its valuation was structuring this investment as debt. as a loan. The intention of this loan is not to be paid back with interest, but eventually to convert into stock. At which valuation? Well, at whatever valuation future investors agree on for this company. And this is one of the reasons why convertible notes are also called bridge rounds, because the whole document structure is to create this bridge to a future round of funding. So just like any loan, convertible notes have interest rates, and they have an expiration date, which we are going to call a maturity date in these cases. So taking this Dunder Mifflin example, let's assume that this investor comes via a convertible note instead of an equity round, and they want to invest the same $1 million. So in this case, Dwight and the Roberts can't agree on a valuation, so they decide to go with a convertible note. So what they do is agree to a maturity date, which is usually 24 months after the investment, and then an interest rate for this investment/loan. That's usually between 2 and 7%. Finally, they agree on a valuation cap and or a discount rate. But to get to how this works, we need to look at some charts again. Okay, so let's say that this investment happens on a 5% interest rate, and that for now there's no valuation cap or discount. So Dwight's investment doesn't convert, $1 million remains as a convertible note. 12 months later, a new super investor comes in. He's super bullish on this paper company, and he wants to invest $10 million on a $40 million pre-money valuation. In this case, Dwight's investment of $1 million has grown to $1,050,000 thanks to that 5% interest rate over 12 months. Dwight's investment converts at the same valuation as the new investor, so $40 million pre-money. In that case, his investment would convert to 262,500 shares. The new investors convert to 2.5 million shares, and this is how the equity distribution looks like. So what happened here? Dwight took this huge risk on an early company, but because a new and bullish investor came in, he only received this tiny percentage of the company. So this ended up being a pretty bad deal for him. That's why all investors will always want to set a cap or a discount rate on any convertible note or any SAFE. The discount rate works by defining a discount on the valuation cap that the future investors are getting. So in this case, Dwight could request a 20% discount on the future valuation. And this is the price that he gets for taking a risk earlier on when the company was just a riskier investment. However, in that same scenario, that 20% discount doesn't really help Dwight too much. With the discount, his valuation to convert would be 32 million instead of 40, which still leaves him with like 2.5% of the company. Again, it's not a great upside for the risk that he's taking today. And that's where a cap could kick in. So Dwight and the Roberts could, for example, agree on a $10 million cap. That means that when a new investment comes into the company, Dwight's investment is going to convert at a valuation of a maximum of $10 million pre-money. After Michael's transaction, that would leave Dwight with a much more reasonable 7.75% of shares. So valuation caps and discounts are mostly there to protect investors from a massive spike in the company valuation in the future. That does not mean that today, when the convertible note is happening, that the company valuation is equal to the convertible note cap. They just mean that they would like protection against a valuation higher than that. When the convertible note converts, it converts at the lowest of the cap versus the valuation minus the discount. So this investment for Dwight doesn't look too bad. He received a fair amount of shares in exchange for his investment. But this document still has some issues. What if the company reaches the maturity date and it hasn't raised any money from future investors? This is a common problem. It actually happened to us. We also made a whole video covering how a company can get out of those cases, because we had to. The point is, convertible notes have a lot of moving parts, they have a lot of variables, and they're not really simple. And that's where SAFEs were invented. So the SAFE document is a pretty standard template that Y Combinator drafted and made public and free in 2013. It is rather new, so many investors aren't really accustomed to SAFEs just yet, but it's definitely a growing trend. Essentially, a SAFE is a simpler convertible note that no longer operates like a loan, so there's no interest and no maturity date. Instead, it just recognizes the capital injection from the investor, it defines a valuation cap or a discount, one of the two, and pretty much that's it. So just like we explained with the convertible note case, the SAFE investment converts into stock on a future investment round, either at the price of that round versus the cap, whichever is lower, or at the price of that round minus a discount. Now, SAFEs are fantastic because they have been standardized. They don't require a lot of legal fees, if any at all. Again, the templates are free, and they fulfill the purpose of letting a company move from fundraising back to work. Fundraising is a big distraction. So a SAFE is really just 5 pages long. Most of the language is pretty straightforward, easy to understand. It defines actions in case the company goes out of business, or it gets acquired, or it goes public before any other equity financing. You can find templates for both convertible notes and SAFEs in Slidebean. And again, you can download a financial calculator to estimate how much dilution can occur with future rounds of funding with one or the other. Remember, this is what we do all day. We help companies navigate this stuff. Our current count is at $260 million raised with our pitch decks last year, just on the rounds that we actually heard about. We can crawl the web for you to find investors for your company. We can help keep logs with our CRM. And of course, we can help companies tell better stories with their pitch decks. You can sign up for our platform for free at slidebean.com, and you can have access to everything, literally everything that we do. If you count the $5,000 in AWS credits that you can have access to, your money is paid 10 times over. Not to mention if we can actually help your company raise capital. We'll see you next week.